I'm Chris Wright, president of Wright Wealth Management Group. From time to time, investors often wonder what type of withdrawal percentage they can be comfortable with in taking from their investment portfolios while still having the peace of mind that they will not run out of money. We all know that most of the major financial institutions have all done studies from their investors on what is the number one fear that investors have. That number one fear always comes back as an investor living longer than their money lasts. Back in the 90s, a gentleman named William Benjamin did a study about withdrawal rate. He was the one that came up with the 4% rule, which basically said if you had $1 million invested in stocks and bonds, you would not want to withdraw more than 4% or $40,000 per year if you wanted your money to last more than 30 years. Some of the things that we need to consider with that recommendation, however, is that in that example, the rate of return that was used for stocks was that stocks would always produce 8% or more, and that bonds would produce 6% or more. Well, we all know in the last 10 years, it's been hard to get over 3 or 4% on bonds unless you wanted to really go out into a very long-term bond. And we know that many investors over the last 10 to 12 years have not earned more than 4 or 5% on their stock portfolios. So really this idea that you can take 4% from your investments may be too much. But for some, it may be a percentage that could be increased to 5 or 6% depending upon the type of investments that someone is investing in. It also depends upon the mix of stocks versus bonds. It also depends upon if somebody has a portion of their portfolio that is using guaranteed living benefit riders for income based upon their annuity investments. We discussed some of those in one of our previous podcasts. The withdrawal rate depends upon the type of investment strategies you're using. Are you a passive investor versus maybe an active and tactical investor? I believe that if an investor has a good independent approach to investment management that includes all of the different strategies that can be accessed via living benefit guarantees or tactical management, an investor may be able to take 5 to 6% out of their total portfolio while still having that peace of mind that they're not going to live longer than their money lasts. Sometimes we see investors come into our office for a portfolio review and the majority of their money is held in bond investments. Well, we know right now with the way interest rates are shaping up to move upward, we know that the value of bonds are going down. So if that investor wanted to always take out 4% out of their portfolio, their constructed portfolio of 80% bonds and 20% equities may not provide the proper growth and income that they're going to need for the next 30 years, and they may eventually run out of money. Something else on the other side that we have to be concerned of is what if another 2008 hits? We know that most investors lost between 35 and 40% of their total portfolios in 2008. And when someone is taking income out or relying upon income in a down market, that can also have a significant negative impact on the portfolio and the portfolio's ability to maintain those withdrawals over time. So this 4% rule that was developed in the 1990s from William Benjamin, I think it's a good baseline, it's a good start. But based upon the types of investment strategies you're implementing, whether you use non-traded investments, annuity investments, tactical management, or a combination of all of those areas, I think investors can put together an allocation that will allow them to take a little bit more money out of their portfolios, allow them to have a strategic goal in mind with those portfolios, where there's a strategy behind each of those buckets of money, if you will, to protect the portfolio when the market's going south. Thus, the portfolio can last for that 20, 30-year period of time. You see, back in 1935, when Social Security was developed, the average life expectancy was 67 years of age. Life expectancies today for men and women are in the mid-80s. We know that we are living longer and longer each year. Many people will work 30 to 40 years in their occupation and then end up being retired for 30 and 40 years as well. So this withdrawal rate percentage is really on a lot of investors' minds because they don't want to take out too much money because they know they may live into their 90s, may live until they're 100 years of age, and want to make sure that they have the appropriate amount of income available to them throughout their lifetime. I believe here at Wright Wealth Management Group, we help investors put together those strategies. We like to refer to that as a roadmap, an income planning roadmap. What percentage can we take out of their portfolio and also provide not only the necessary income, but also that peace of mind that they're looking for. And we can accomplish this through many different avenues, but mostly through the tactive and active management processes that are out there and available to investors today. I'm Chris Wright. Thank you for joining us today concerning withdrawal rate percentages and how that can impact how long your portfolio lasts. We hope that you'll join us next time for additional financial topics.